G'day everybody, Brian here from quantlabsnet.com. I am going to show you if you trade any crypto, specifically Bitcoin, you may want to hang around and watch this fully because if you don't, uh, that right there is enough to make you lose money in this space. And if you don't know how these trading firms, high frequency trading shops, hedge funds, and the like pretty well take your profit potential away from you. And we're going to reveal that in this video using all the quantitative techniques they use, all of the high frequency trading, what they do as well. So let's dive deep into this. Okay, so yesterday I put out probably one of my most important videos, high frequency trading in Bitcoin, institutional strategies and missing techniques. So in here, this is very long. This is the introductory to it. Um, and I'll kind of go over this as best as I can. But where it really gets more interesting is this one, where I put a comment in. I went very deep, far and wide. So there's this PDF available. I'll show you this um, here if I can find it right here. Let me just open it up. So this is it here. So these are just table of contents. This is over, I believe, 40 pages. This document, and this I've not done this kind of analysis before, not this deep. So you can see there's about 10 sections. We cover here is the core strategy, multi-leg arbitrage when it comes to high frequency trading, using futures basis, volatility, surface arbitrage, order flow, typically the capital requirements for doing these type of trades, which is quite a bit. How the institutional from the high frequency trading, hedge fund, and more of the advanced trading brokers and whatever take advantage of this by institutional, and that's it. The hidden secret data sets, the alternative data sets that a lot of people pretty well probably don't even know. So we're dealing with sources from CME, Binance, Futures, Order Book L2. We also can look at options chain data from Terabit and uh, OKX. And here we want to cover our implied volatility surface as well as skew. So as you can tell, what I'm talking about here is options because this is where most of the action takes place. If you want to know more on how to proceed to learn this sort of thing, what I've done now is I have now a new section on my website here at quantlabsnet.com where you can book a 15-minute appointment with me and just kind of try to understand stuff like this, whatever you trade. It's now down by the market, not just generally in all asset classes or major assets out or instruments. It's even in Bitcoin and Ethereum, and there is a distinct difference between Bitcoin and Ethereum based upon volume and that. So at the end of the day, if you want, just click on that booking button and book a 50-minute session with me, and we can definitely go through that. Okay, so let's continue along in the PDF. So here we have macro hedge fund positioning. They do use the COT, the commitment of trading reports. I didn't know this, but apparently these shops get this report 3 days ahead of what's put out in the public domain. I did not know that. So that gives you right there the advantages that the firms have over retail and public knowledge. Also, we have here the different methods we could use, stochastic calculus with options. We also have machine learning based upon order flow, game theory, volatility clustering, and I've shown in my memberships that the three major pieces of different types of algorithms that are layered upon each other to develop these kind of overall trading systems, and they are traded literally in the millions, probably billions per day. There's different exits and strategies or entries using all these different techniques, and there's a lot more. This is just the high level of it. So here we have futures uh, divergence, basis divergence, using arbitrage, option IP, ranking, and term structure, dark pool, trading detection, liquidity heat maps, and order book imbalances. Okay, this is again only for Bitcoin in the institutional space. So this is another important one that people are really one not aware of is how the HFT move the market without hugely impacting it. You can set these time weight average pricing, volume weighted. You can do these iceberg orders, spoofing as well, and layering detection. So this is now what you need to be aware of. Predatory HFT, they pretty well can get away with it. And one of the conclusions you'll realize is that these firms will trade against you, and there's no doubt. And it's also the same um, in the Bitcoin institutional space, where it does have impact on retail traders, no matter where you are. So here we can look at different examples with futures contango and options skewing or options skew step by step. Again, I don't go into detail. This is very high level. So then we get into portfolio Greeks, again, options, delta, gamma, theta, all that, tail risk hedging, put spread versus variance spread. Also, there's liquidity crisis protocol as well. So things to protect you are the circuit breakers and the kill switches out there that the institutions have or the exchanges have. And it just goes on and on and on and on and on. That's just the very deep one that goes well over 40 plus pages. There's some sample code here. One of the things I want you to be aware of is right here. The bottom line, can retailer traders win through all of this? So essentially, you could look at this as being a retail trader survival guide, as it says, know which data to use. These two Glassnode, Nansen, these, as I said, these COT might be too late by the time you get them because there's 3 days ahead that the firms get it. You have to understand the limit orders, the hedge tail risk, risk before the entry, automating where possible. I'm telling you, you have to automate now. You can't do this buy and hold. You can't do this with standard watching what happens in a chart. Just doesn't work anymore. It's been proven. That's probably why a lot of people will always argue that they're turning profit. They take profit and then they give back to the market with a buy and hold as well. And a lot of people drop out because if you pipe a lot of money into Bitcoin, there's also something called opportunity cost, where at that time you could probably get better performance in other instruments as well. So let's go through what we can do here. So there's a variety of traps. So the firms, institutions will exploit liquidity in various ways. They have their strategies, but you can try to do it in a simplified way, which I try to do. Again, basic hedging, better execution, put you steps ahead of the standard, call it dumb money if you want, or the retail trader. We also have to obviously focus on risk management. There's the right way and wrong way. And again, number of reasons why retail traders lose. And you have to trade like a sniper as well. And you have to have higher quality trade instead of just trading a lot. So, quote from John Maynard Keynes. Now, this is important to know. Okay. Inst- Institutions know um, they trade accordingly. Retail traders forget it and they pay the price. So again, here what we're dealing with specifically in crypto, namely in Bitcoin, that is a big one, is we know how to beat the markets, beat the whales basically, because this is basically what we're doing here is we're whale watching. We have to know how to survive long enough to profit from their mistakes. And that's pretty well it. But as I said, the the institutions will always manipulate the trades. They get away with that. That's part of what they do as well. Okay, so this is a long version of this PDF that you can download as a paying member. All right, so let's take a look at some of the other things I could show you. So now we're going to get into the nitty gritty. This is um, a very high level. Actually, let me just make sure I got the right document here. Yeah, so that's the shorter one. I just want to show you the different techniques a lot of these firms use and why you're probably not making real solid profit off of Bitcoin unless you're doing the buy and hold. As it said, when you get a crypto winner like I had a while back, when you're sitting for 2 years waiting for Bitcoin to move, those are 2 years of non-performing assets that your money's tied up in. As I said, you could put that into other things that are moving, be it gold, be it whatever, or the markets themselves, and retain profit. So this is what we call, as I said, the opportunity cost, not the best way to trade. So there's a standard basis arbitrage where you buy the BTC, you reversing carry, shorting it. Also, you could profit from the backwardation. Um, Here's the hidden trick a lot of people may not realize that both CME, Deribit, Binance, you can see the different cross exchange arbitrage, and that's between those three. Probably make some bucks there still, I think. So here we have to understand the math behind it, where sell a future, buy a spot, buy a future, or short a spot. There's a trading logic here. Many of these firms will use dark pools to hide their large spot trades. And more importantly, you have to avoid that slippage as well. Again, another way to do it is volatility surface arbitrage. So here, being in the options market, knowing it, you can do the implied volatility, realized volatility, uses volatility smile, basically purchasing out of the money put and call where they're overpriced, and using various hedge swaps where your hedge is they get exposed. Okay, so that's another unique way to trade crypto in the finance, in the big finance world. So there's various models used here. The Haston for stochastic volatility, SB, SABR for the skew dynamic, and the Dupire local volatility modeling. Okay, so this one can also be used for market making as well. So basically, example, sell an OTM, the high IV, buy the OTM call, low IV, delta hedge with futures. And then from what I'm learning more and more, it's the delta hedging that can help in a lot of these, or what a lot of institutions do to protect themselves. Um, we can also track hidden liquidity to front run the retail traders. So again, right here, front run the retail traders. So they are watching certain data sets that we, the retail trading world, do not have access to. And what do these firms do? They front run retail traders. Um, so essentially that happens on the bigger free broker, uh, free brokers out there, and they're free for a reason because they sell the order flow to these firms and then they front run their own clientele. That's why they're free. And I know a lot of people will like scoff at this. Personally, I don't, it doesn't bother me because the louder ones are going to be the ones booing from the nosebleed seats, and they're probably losing money. And always remember, the nosebleed seats are the cheapest seats in baseball. So dark pool and block trading as well, where you could detect. These are the various data sources that you can use: Bloomberg, Sigma X, LiquidNet. We could crack the OTC before they hit the exchanges. These are data feeds that are probably thousands per month, thousands per year. We have also Whale Alert and Glassnode, watching blockchain flow, exchange flow, uh, which brings back exchange inflows, selling pressure. Um, so here, obviously, we're using OBI formulas here. So some of the trigger points here, if the OBI is 0.3% or zero point 0.3 buy pressure, if it's less than 0.3, it's a sell pressure. So then another thing they can use is liquid heat maps, liquidity heat maps. This is important too because here it identifies stop hunting zones, which a lot of brokers, maybe other exchanges do, or the shops themselves do in the futures and options world on big exchanges like the CME. This is where you start to see liquidation clustering. And this is the other big thing as well. Detect spoofing, which are basically you hear about the fake orders that disappear before the execution. That's what a lot of these firms do, specifically at the HFT, where they'll test the market, run out the price maybe two, three times, maybe five times. What they're doing is they're trying to eliminate the retail trading crowd that's watching this, and they're shaking off the algos that they use um, uh, to put the big orders in. And then once a lot of those retail um, algos are shaken out, meaning that they're no longer falling because they think the market will disappear or go down, it's because of this spoofing, which is illegal theoretically, but they've been talking about all this for decades now. And nothing changes, specifically in the U.S. exchanges. So it's going to be there probably forever um, until they formally make it illegal. But all the big crypto exchanges allow this, especially if they like a Deribit as an example. Um, so then we get into high frequency market making as well. So what they're doing is they're providing liquidity and they're avoiding the adverse selection. So they're able to watch their spreads, which if you watch my prior video on the Bitcoin bot that was built, and you can see there's a one section on spread on the analysis on the spread. This is what we're talking about here. Right here is watching the spread um, based upon volatility of the market using this particular model. I'm not going to mention here. We have a formula for that to measure the bid and the ask. Okay. And then we can also cancel an order. So that's how it's done. That's from a mathematical perspective. So there's also latency arbitrage as well. So some of the bigger firms will allow co-locating servers near the exchanges, essentially meaning it's in the same data warehouse with direct access to the CME, to Binance or Deribit. I don't know if Binance or Deribit allow direct market access. Um, Maybe they do. We don't know about it. Maybe you have to have a certain size. Where they'll let you know about it. But definitely you could do that in the CME where the CME volume is building as well. The other big one that a lot of these firms, like he mentioned, this one example is Citadel, where they build up these microwave networks to beat fiber optics by literally milliseconds. So what Citadel's done is they built out their own private microwave network. And again, about 2 weeks ago, the AI told me they spent 1.5 billion on it, and they can pretty well get it to almost 0 microseconds. Very close. It's minimal. You wouldn't even notice it. And then there's of course there's the secret stuff, the secret sauce stuff. We have some examples here. Again, this is the high level. We're not going into the detail yet. So here we have the hidden liquidity detection. So with the iceberg order identification. Now this is again using machine learning. Just so you know, with some of the examples that I built out in C++, some of the bigger programs, apps, whatever you call them in C++, I can build in a mini neural net. So a lot of these AI generated projects in C++ specifically at the low level, if it even sits on an FPGA, it can have its own built-in machine learning techniques. In that case, it was neural net. And here, what they could do is, as an example, they can do 50 Bitcoin bids refill every 10 seconds. I mean, that's pretty incredible. And that's how fast. So we have the order to trade ratio at 10 to 1, which is likely spoofing. So they are able to detect that again mathematically by analyzing the data. Pretty well, only the high frequency trading firms have that access. We have the predictive machine learning. This one, LSTM, is the most popular that I've seen. What we're looking at is forecast short-term pricing using order book imbalances. There's also the reinforcement learning. So we're optimizing the market making spreads as well. Just high level examples of how these are used. So we also, as I said, we have game theory for market making. So we have the adverse selection filtering, where we cancel orders if a whale enters the market. And then we have the ping orders, which is testing the market. So it's testing liquidity without revealing the intent, which a lot of these firms do. So I just want to mention that a lot of these things that I'm mentioning here are generated by AI. If you know how to prompt the AI and knowing which LLM to use, and you're willing to spend that money, it will reveal these kind of secret sauce tips that I've gone on about for the last 2 weeks. But this is specifically for Bitcoin trading and how a lot of these big firms trade now Bitcoin. And this these LLMs are starting to peel back on how it's done. But as I said, this is just the high level. The PDF that I showed earlier shows you exactly how it's done, and that's not complete. But there's some very specific examples of how that's done. Again, that's only for my paying members. So again, another thing that they do is they use a cross asset correlation. So what they could do is a popular one is Bitcoin against S&P 500. I've seen it against gold. I've seen it against bonds. A decent one that I've seen that works is against US dollars. So if the US dollar performs, Bitcoin drops and vice versa. If you look at and overlay the two charts, Bitcoin and specifically DXY, the dollar index, you'll see that relationship there somewhat. So if the S&P drops, the Bitcoin often follows with a correlation of zero point 0.6. Same with rising bond yield because Bitcoin's looked upon as a safe haven, quote unquote safe haven, and Bitcoin actually goes bearish, inverse correlation. Then we have the regulatory arbitrage. So we have the OTC desks over the counter versus the public exchanges. So institutions trade large blocks off exchange to avoid slippage. Retail traders get in front or get front run by the HFT shops on their public order. So realize that there is private through the dark pools as an example, and these are off exchange, avoiding slippage. And then we, the retail traders, again, as it says here, we get front run by the HFT shops. So here's some of the reasons why a lot of retail traders like this goes across all asset classes, specifically Bitcoin, crypto, and probably Forex as well. It is a Forex. So there's a lot of, as it says here, the structural disadvantages. It could be information asymmetry because of dark pools. As said, the COT reports when traders are sent again 3 days earlier. And we also have something called dealer gamma as well. Execution speed, and as I said, of course, that we all know, HFT is in microseconds, while retail trading is in seconds. There's a capital leverage. Institutions move markets, retail gets liquidated. And that's the AI speaking, not me. So how do we compete against it? Well, we have some expensive data we could know about. Uh, Glassnode, Nansen, on-chain data, with the limit orders. I didn't know this. I really did not know this. You avoid market orders because the HFTs will pick off the market orders a lot easier than limit orders. You hedge with the options. You buy cheap OTM puts and avoid over leveraging. So conservatively, institutions will use 3 to 5 times. Retail uses up to 100 times. That's courtesy of exchanges like Binance. Okay. So institutional traders do dominate the Bitcoin markets through things that we retail trader market does not have: data speed, quant modeling. Retailers can try to replicate it. Understand them also helps avoid common pitfalls. That's what I'm here for, to show you some of these examples of the coding and all that. So here we got to trade like a sniper, higher probability trades, especially if you're in the spot market, you're going to get killed regardless. I don't care what you say. If you're in the futures market, options market, you have better opportunity, but you really got to know the space and how options and futures work. Know how to use the different things like Greeks and all that sort of stuff, proper hedging, proper arbitrage. Again, I have a whole course on that. Focus on execution and risk management, not just the entries. That's another thing. People will focus on the entry, but the more important thing where the profit or loss comes in is the actual exit. And then the big thing is to know how these HFT shops work so we can avoid these traps that they set: spoofing, stop hunting, liquidity voids. And I think that will be here forever and ever and ever. Okay, so this is going to be a very long video. But again, this is specific for Bitcoin. So again, we're looking at options futures and the hidden market strategies, market making strategies. Okay. So this next section I'm going to talk about is basically the summary, AI summary of that massive PDF I talked about here, this big one. So what I'm going to talk about here is the summary of that. Okay, so as you can tell, the Bitcoin market has gone through a profound metamorphosis, and it's going to continue to evolve with all these new regulation, these new acts, and blah blah blah. Also, when it comes to ETFs and how they impact Bitcoin, so it started obviously in the retail market with these crypto anarchists, speculative day traders. So it's a multi-trillion-dollar asset class, pretty well dominated by institutional players. So all of these people, the crypto anarchists and the speculative day traders, are getting blown out each and every day, especially if they're trying to trade like this and they're tying up money um, with Bitcoin. And you can see how easily it can be manipulated. And that could be said for a lot of asset class or a lot of different instruments out there that we traded on the CME, Chicago Mercantile Exchange, and the like. So, what these shops have are access to dark pools, level three order book data, and proprietary blockchain analytics that I've already mentioned some of the data feeds that you can get for pretty well thousands of dollars per month. There's also a technology superiority, specifically with FPGAs. Very complicated to program, very expensive to set up. And then we also have these market making models that can execute trades in microseconds. And I've got developed projects that can do millions of trades per second in nanoseconds. So it's beyond that. And I've got some projects I've shown in my membership with that. So again, we have capital structure and advantages. A big one, a lot of these, a lot of the institutions may not talk about, you may not even know that those firms will have advantages and really decent relationships with prime brokerages, OTC desk access, where they get favorable leverage terms, and the ability to move the markets that will not move against themselves. Okay, so we have this multi-leg arbitrage with HFT execution. I've talked about the future basis trade. Again, that's just something which is a cash and carry, cash and carry. Um, Examples here would be buy a Bitcoin spot, simultaneously sell in the futures market from that basis, which is the difference between the higher futures price and the spot price. It could converge to expiry, and you could where it works in contango and your futures is greater than your spot. So the reverse, I guess, would be the opposite. Um, yeah, this profit from backwardization where the spot is higher than the futures often causes extreme negative funding for perpetual stops. Okay. So right there, from a retail's perspective, you can imagine why futures perpetuals are pretty popular, but they may not be the most profitable. So, what was I saying here? Okay. So this is important to know. Okay. So the institutions love this because it's pretty well, as I said, theoretically risk free and it's an unknown return. It's a way to earn a yield from the basis on a spot Bitcoin position without price exposure. This is the trick that they use. They don't look at one exchange, they perform cross exchange arbitrage on CME, where the institutions are, where they get the basis from Binance and the general retail sentiment, which is Binance is pretty well the largest crypto exchange in the world. And then for Deribit, it's the options powerhouse as well. So those are going to be the three major exchanges, and they participate often using. So this is a triangular arbitrage, really, which one using spot from one venue, futures from another, and all while predicting funding rate spikes using the open interest and liquidation heat maps to time their entries and exits. So that's just one way to do it. And most retail traders will never understand that. Most retail traders will still think trading via charts and their indicators is the way. I'm not going to get in that. All I know is that it's not the way. So there's always the math behind it, where we have the futures price. Again, we know our risk-free rate, cost to carry. That's important to really, really, really know in the futures world. Okay. Um, and that's part of my course has that. That's what I'm saying. The course is so paramount to know. To know. So we have the physical commodities. You have storage, insurance, and the funding rate in crypto. I never would have thought that myself. Then we have time to expiry. So again, if the future is overpriced, we execute cash and carry. We'll sell a future, buy a spot. Or if it's a reverse, the futures enterprise execute the reverse cash and carry trade, buy future, short the spot. So what are the institutions doing? They're not really just buying up Bitcoin with a market order of 10,000 Bitcoin. They'll split it up using liquidity venues, again, Binance, Coinbase, Kraken, OTC desks. They will use dark pools. They will use iceberg orders, acquire the spot position without telegraphing their intent to market. So they're spreading all those big orders over all these different venues, even in the retail crypto exchanges. They hedge the tail risk, spot the crash blowing. This is one of the reasons why Bitcoin's so volatile. Is because of this style of trading that only the institutions are really doing. Um, so they spot market crash, blowing through their arbitrage margin by buying out the over out of the money puts. So again, that's one of the big advantages with trading like this, both in the futures and options. You can protect yourself on the downside. You can also obviously profit in a very unlimited way with the option side as well. So one of the modeling that they do this is, well, the core of it is Black-Scholes, where it assumes constant volatility, which is true. The IV or implied volatility options using a strike price and expiry, this creates a volatility surface. Again, I've shown this, or the people at Lightning Chart have really good charting for this, as I've shown before. Okay, so we have mispricings across the surface. We bet the IV will converge at a fair value, or that the relationship between the points and the surface will change. And you can adjust your trading based around that in an automated way. So again, we have the volatility smile, tendency for OTM puts and calls to have higher IV than the option, the money option, or at the money option. We have the term structure, which is the difference between short dated and long dated IV. So they can sell the overpriced front month volatility and buy uh, cheaper back month volatility in the calendar spread, or they may exploit the skew, which is the difference in IV between OTM put and OTM call, which represents the market crash fear. So again, these are the modeling Heston SABR local volatility model like the Dupire equation. Okay, so they have the different examples here. Okay, 25 delta put uh, with an IV of 80%, while the 25 delta call have an IV of 70%. This plus 10% skew indicates extreme fear. So mathematically, you can do this. So you trade the overpriced OTM put by the relatively cheap OTM call, and this is your skew trade. So here we're hedging on either direction. Future dynamically adjust the position delta to be neutral, isolating the bet on volatility. Boom, right there. Isolating the bet on volatility. So in a volatile market, you hedge in these different ways, and you can neutralize your volatility. That's pretty nice. So that's why Bitcoin can be a great asset to trade if you know these sort of things. But where else would you know it? And the AI is not going to tell you this unless you know what to ask for. So here we have option chain data from Deribit, OKX, and CME. And I've talked about the option chain data, how valuable it is. It will reveal historical volatility data and crucially dealer gamma exposure reports to understand how market making hedge flow might impact the volatility. So this is the underlying reason why we have volatility in the Bitcoin space, to understand that in a deeper level. So here we have order flow prediction with a dark pool versus a hidden liquidity. So here we have a public order book. That's what you're going to get from your exchange. Tip of the iceberg. So the institutions predict price moves by analyzing hidden liquidity, which are large block trades and dark pools, and iceberg orders within the exchange themselves. So what are they doing? They feed that shows block trades from dark pools. Again, here we go. Two examples, LiquidNet and Bloomberg AES before the pressure hits the public markets, public exchanges, your Coinbase, Kraken, and the like. Seeing a seller consistently hitting bids in the dark pool, they can short futures on the public exchanges ahead of the move. The question is, how long are we talking here? Is it a couple of minutes, a couple of seconds, a couple of hours, maybe a couple of days? I don't know. So the math behind this is very interesting. So we have the order book imbalance, OBI. If you looked at my previous video in the application I built, it's measuring the OBI, and that's what it's looking for. So if you got the right access to the right data, you could quite possibly be able to do this at a retail level. We have the bid volume minus the ask volume divided by the bid volume plus the ask volume. So again, here's the actual value, which is nobody talks about. If the OBI is greater than 0.3, strong buying pressure, okay? Or if it's negative, greater than negative, or sorry, less than negative 0.3, indicates the selling pressure. So you can do equivalent of a swing trade here to make quite a bit of cash when you're analyzing these sort of things. We also have volume weighted order flow, track whether trades are initiated by buyers, aggressors lifting the ask, or sellers hitting the bid, providing a real time pulse of market sentiment. So here is your data sources you can watch. These are again worth a lot of money, thousands of dollars per month. So we have LiquidNet, AES, Sigma X, dark pool trade, size, price, direction. CME and the Binance L2, L3 plus the order book, or the order book L2, L3, hidden liquidity, iceberg order detection. This you might be able to get access to. Also, we have Glassnode or Nansen, whale wallet movements, and exchange inflow outflow. And then, of course, we've talked about the CFTC, COT, Committed Trader Reports, hedge fund, and asset managed position. So it's not just about watching the COT, it's got these other three metrics as well. So the other area to kind of talk about is high frequency market making, which is basically the dynamic order flow placement. If you're good at this, this is probably the most lucrative of them all. This is where the HFT firms are making most of their money. Okay, namely Citadel as well. So market makers provide liquidity by continuously placing bid and ask orders. So those are in the millions per day, per second, per minute. Profit is in the spread. The risk is adverse selection, getting filled on a buy order before the price drops or sell order before a rally. Okay. So that's their goal, especially up against the retail market. Smart money is doing this, what I'm talking about right here. And then again, I keep saying the dumb money, which is the retail. And many people argue this. Whatever. You can argue all you want. It doesn't take the fact of what's happening in the markets and how it's done underlying at an institutional level, legal or not. So this is the important part. Hidden institutional trick. It's a dynamic game. It's not passive. The game theory to model the behavior of other traders. They widen the spread because they can do that during high volatility to protect themselves. So they can force the market to go into high volatility and they make a lot of money from it. So they can have systems to detect the predators because all the other HFT firms are competitors against each other. So one HFT firm will think upon their competition as predators, but as a whole, they're all predators nonetheless. So these are large informed traders, and of course they're going to be informed by having access to these data sets or data feeds. and will cancel their orders milliseconds before they're executed by them to avoid adverse selection. This is the sketchy part. Cancel their orders milliseconds before they're executed. That's what people do not like about HFT shops. Okay, so again, they have this model, okay, cornerstone for optimal market making, where they calculate the bid price, ask price, where you have these formulas, risk aversion parameter, the mid price, the volatility time horizon, inventory risk uh, penalty, and the order fill probability. Okay, so this is all futures and options talk again, which is part of the course that I've got. So you could dynamically adjust the quote based on volatility. So they can adjust the quotes based on volatility, risk appetite, and current inventory. So this is how they do it from an institutional level. They co-locate, we know that. We have adverse selection filtering, which you may not have heard of. So they have now these AI models identify order flow that is likely informed and avoid providing liquidity to it. But that's where the retail traders come in to provide that liquidity by the time they think they're in something. It's too late, and these firms, institutions take advantage of it. Then we've already talked about the cross exchange arbitrage. And there's also this tail risk hedging, skew trades and variant swaps. So here, it's based around black swan events, which we're going to get a lot of moving into the future with national debt too high, blah, 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 blah. And where it gets even more lucrative is as the firms panic and the traders panic, be it in the commodity space, be it in currencies, or be it in the market indices like the S&P 500 and the like equity markets, they're going to go into Bitcoin. And because of this is where you could do very well in Bitcoin, knowing how these institutions trade. So people don't want to hope for it, but these firms probably are hoping for it because they systematically hedge against them, even profit from the market overpricing from the fear. So yeah, you can make money from this type of panic because they're informed. So what's the hidden institutional trick? They finance the tail risk protection. So how they do that? They sell OTM puts for like premium and use that premium to buy variance swaps or far OTM puts. This creates a position that's highly profitable if the market is calm from the premium collected, or if it crashes violently from the hedge, while minimizing the cost of carry. So they're making money on both ends in a calm market or an extreme crash. To me, that's brilliant. Um, is it legal? Is it moral? That's another story. So how are they doing it? So we have something called a variance swap payoff, which is this formula right here, where n is the notional value, again, feature and option talk, where the sigma realized is the actual volatility over the period. And the K strike is a fixed volatility strike set at inception. That's going to be set by the exchanges. This allows for pure volatility trading, isolating the direction from the underlying asset. So here, as examples, and this is pretty interesting, but that PDF I mentioned here goes through this in so much detail. And you can generate a lot of code from that as well, which I thinking about it, this would be an interesting place to be in. Anyways, how do they do it? So we have a sell 10% OTM put, collect a high premium due to elevated skew. We buy a variance swap with a strike slightly above the expected volatility. Then we do a delta hedge, the entire position with the futures to remain market neutral, which is what you want to minimize your risk. The trade profits if volatility remains stable or increases moderately and is protected if the volatility explodes. So there you go. So we're now 44 minutes in. Now you know how to do it at both ends in Bitcoin. There you go. Capital requirements of broker size accounting code. This is where it gets very, very interesting. Institutional trading is not about picking the right trade, it's about sizing it correctly. And it's not about secretive algorithms or algorithms working together. It's out there. It's known if you know how to ask the AI the right stuff. So here, what we're trying to do, and it's especially true as we move into an unknown future where we have to be able to survive these inevitable drawdowns and be able to survive these liquidity crunches. That said, there's two spaces the traders will go. They're going to go into either gold or they're going to go into Bitcoin. So knowing this stuff, you're ready, and if you got something developed, you can make a lot of money here from any potential crashes, drawdowns, and extremes. So here's how it works: margin leverage calculation for future option. So we're going to need to have access to all of these. CME Bitcoin Deribit on the spot Bitcoin and the OTC block. Margin requirement 10 to 20%. Leverage at 5 to 10. You don't want to go too crazy on this unless you know what you're doing. So liquidity risk is low because it's institutional. Bitcoin futures at Binance 1 to 5%, 20 times to 100 times. So the liquidity risk is high because it's retail. Bitcoin options, premium and margin. Uh, this varies at the different strikes, and the medium is risk because you're involved with the IV crush risk. And then the spot Bitcoin OTC margin requirement 100%, leverage one time, and it's low if you have access to those dark pools. So here again, this is not for the poor people. Will say I hate to say that, but $1 million maybe from an institutional position. So these are some of the examples. So we'll put a futures basis arbitrage, 400 grand margin requirement, 80K at 20%, leverage at 5 times, risk per trade at 1%. Then we have the volatility arbitrage at 3,000. Margin requirement or margin used is 50% 150, leverage 2 times, risk per trade 2%. Then we have the HFT market making 200K, 20K, 10 time leverage, risk per trade, which is fairly low. And that's probably your most lucrative right here, 0.5%. And the tail risk hedging as well, 100K, 50% requirement, 50% margin used, 2 time leverage at 1% risk per trade. So here, total margin use 3,000. And you have a cash buffer of over 700 in case there is a liquidity crisis. So basically, you're essentially uh, really only putting 300,000 at risk, but you have to have the extra on reserve if there is a liquidity crisis where you have to cover those losses. So the allocation ensures that if several strategies face simultaneous drawdown, the firm has a massive liquidity buffer to meet any margin call and avoid forced liquidation at the worst possible time. Okay, so now there's liquidity slippage adjustment, and you never trade more than 5% of average daily volume in a single order. 10,000 Bitcoin order in a market with 200,000 daily Bitcoin daily volume will inevitably move the market against you. So no more than 5,000 of that, so no more than 5,000 Bitcoin from an institutional level. So here we have the slippage cost. Again, trade size 100K, order quick depth, top 10 levels, 500 Bitcoin, spread at $10, slippage cost. Using this, $200 total slippage. So this is how the institutions avoid that slippage. Iceberg orders, dark pool, crossing networks, as I said earlier, how they do that. So then the risk management, they're using value at risk, stress test, and drawdown limits. So the value at risk, which is pretty standard across all risk um, management techniques. This is the maximum loss over a specific period of time at a given confidence level. Okay, that's usually 99%, 95%. So we have here, my name is this symbol, is expected value, often zero for short term, or the Z score is another way. And I've seen entries and exits based upon the Z core. Z-scores is 2.33% at 99% confidence. Or if the sigma, the volatility of the portfolio volatility, and the T is the time horizon. So again, here we have 1 million portfolio with 3% daily volatility as a 1 day 99% DAR, which results in 69,000 value at risk. As I said, they can do stress testing. We have different scenarios that you could run where Bitcoin drops 30% a day. That's known to happen for quite a bit. Or the volatility spikes to 200% to understand the impact on all your positions in the portfolio. So we have here the drawdown limit. These are hard rules set. Trigger reduction at risk or a complete shutdown of trading, which is key. Okay, like what they use in circuit breakers. We have a maximum daily loss of 2%. So again, this is using the equivalent of a Kelly criterion. So 2% if hit, trading is halted for the day. That's internally. If your max drawdown is 10%, usually 15% overall. So 10% here is the metric. If your account loses 10% from its peak, all positions are reduced and strategies reevaluated. So that's your risk management. So we have institutional hidden market secrets. The greatest edge, which institutions have, is the uh, institutions see the market in high definition while the retail looks at a blurry of a snapshot. Okay, so that's very true. So we have the CME Finance Futures Order Book L2. We have large bid ask wall. Potential accumulation or distribution must be checked for spoofing. So we talked about OBI, and we've talked about those metrics for the bullish signal. Liquidation cluster. I don't think we've talked about this. Using data from platforms like Coinalyze, Bybit to see where the large clusters of leverage on the long short positions will be liquidated, creating your stop hunt zones. Very interesting there for your stop hunt zones. So you have your Deribit OKX option chain, IV surface, and skew. So this is the IVR rank. That's implied volatility rank. IV stands versus its 52-week range. IVR is greater than 70% strong, so just strong selling premium. IVR less than 30% buying volatility. So these are good metrics for know your part of your entry exit. Term structure, first month IV is significantly higher than the back month IV, which gives you that backwardation. Signals acute near-term fear, often a contrarian buy signal for volatility. Then we also have our skew, 25 delta put IV, and the 25 delta call IV. High skew means puts are expensive relative to calls, indicating fear. Institutions might sell this fear. More gold nuggets there. So here, where do we get the data for the dark pool print? Liquidnet, Bloomberg, AES, and Sigma X. So this is what a lot of firms will use is dark pools to hide liquidity. Print showing 500 BTC block trade at discount to the public market is a clear bullish signal, which people won't see. But they're loading up way earlier than the public. Institutions pay hundreds of thousands of dollars per year for real-time access to the data to front run these flows. I don't think this will ever become illegal over 3 different arenas, be it the CME, Bitcoin, Binance, and Deribit. So blockchain flow order, okay, we all track it basically. We have the exchange net flow. Exchanges suggest investors looking to sell where it's bearish. Net flow, outflow suggests coins are moving to cold storage for holding, which is bullish. Okay. So when they come drawn off, yeah, they're holding those for storage, in cold storage, because as they grow in value, which is bullish. So here's the important one as well. The whale transactions. So we're tracking now on the blockchain wallets of large holders, and you can tell who they are by tracking those. providing early signals if a known whale starts splitting and depositing large amounts to exchanges, often preceding a sale. So watching this type of data is so important. We have the macro hedge positioning, the COT, and dealer gamma. The COT, which is from the CFTC, release weekly and show positioning of non-commercial, speculators, commercial hedgers in the CME, extreme long, net long positions by speculators, often contrarian indicator. So this is dealer gamma. This is an important one I've never heard of. Market managers are short gamma. Their hedging activity, buying high, selling low, exacerbates the market moves. Long gamma, they stabilize the markets. Tracking this exposure is via firms like spot gamma, powerful edge. So then we have the quant modeling, proprietary math that we've talked about as well. So again, retail use indicators, institutions use calculus and machine learning. That's the difference. Retail uses indicators, charts, and all that. Institutions use calculus and machine learning. This could be said universally right across the board, but you want to trade like the institution, even though you may not have access to the uh, expensive proprietary alternative data. You can still trade off a price and bid and ask, knowing where to go publicly. And then again, you can use these models, as it says, Heston, SCBAR, understand dynamics of volatility, fare beyond the capabilities of Black-Scholes. So Black-Scholes is just a simple formula used in all this. My course covers that as well. But there's all these other different modeling, and these are pretty popular. I've seen these come up a lot. Heston, SABR. So the machine learning, the LSTM, predict short-term order flow and price movements. So then we have the reinforcement learning to train market making agents that can adapt to changing market regimes. So right there, market making trading AI agents in the market. As I said, also we have game theory, models that are predict the behavior of other market participants, the context of HFT, and avoiding those adverse selection. I've talked about this many times, Garch modeling, model and forecasting the volatility, crucial for sizing positions and pricing options. They capture the volatility clustering phenomenon common in Bitcoin. Okay, so this is now exit and entry triggers for institutions. So knowing this is going to be a huge thing. So right here, they don't wait around for the RSI to cross 70. Their triggers are based around convergence of data. Okay, if you haven't figured that out by now, we have a futures basis divergence, the basis between CME and Binance futures widen beyond statistical normal threshold, triggering a cross exchange arbitrage trade. We have also option IV rank and term structure shift. When the IVR, remember that's implied volatility rank, crosses above 80%, our term structure inverts signaling an opportunity to sell. Then if you can, on those data sets and data feeds I talked about, dark pool block trade selection is another big one. To watch large sell side blocks of dark pools triggers a signal in the public futures market later on. We also have liquidity heat maps. Uh, liquidity void below the current price with a cluster of stop losses just below it. Signaling, and this is a very interesting way to put it, high probability, sharp cascading move down if the support breaks. So that's what the institutions are watching. This one I just mentioned, the convergence of data. Then we also have the execution. This is what HFT shops are using without moving the market. So they're using the TWAP. Okay, I'm not going to go in that. VWAP, iceberg orders, spoofing and layering detection, which I've already mentioned. So there are large orders meant to manipulate pricing. Okay, I've talked about that as well. Protecting themselves from predators. I'm not going to go into these examples here. Okay, but right here, risk management, how institutions avoid the blowing up. They have their Greeks that they use. So they're using delta, gamma, acceleration price move, vega, which is supposedly the secret one, beta, time decay, or rho, interest rate. Tail risk hedging. Case study hedging is not an afterthought. It is a core part of strategy design, often financed by other parts of the trade. Talk about that allocation of 1 million. Liquidity crisis protocol. So these are internal automated kill switches. Unwind all positions if the margin equity falls below a certain threshold, or if the exchange connectivity is lost. So you can't really rely a lot on these circuit breakers, pause trading periods during extreme volatility. You want to measure that internally in your own system. So this is important also to know why crypto retail traders can't compete, but you can get closer to some examples. Uh, Institutional edge is vast, as I mentioned, superior information technology and capital. So the retail traders are in effect the liquidity that the institutions harvest. That's said right across the board in all asset classes and instruments. Um, they see your stop losses. If I've talked about for the years. Front run your market orders, so that right there, market orders, not limit orders, and profit from your emotional decision. So what do? We need to emulate their mindset. Trade less, trade smaller, focus on risk management first. Your goal is survival, not quick rich stuff. Upgrade your data to either crypto, quant, or glass node for on-chain analysis. Sometimes you can pay, and this is true. You can view it through TradingView and read the COT reports. So you can improve your execution. Never use market orders. And I've always did that, thinking that that's fine. Use limit orders and learn to scale in and out of positions. Think about slippage as a primary cost. That's something I need to work on. Simplify these strategies. Don't do multi-leg arbitrage, or you can't do it. Um, you can avoid buying calls when the IVR is over 80%. Consider selling a premium. Watch for extreme basis fund rate, contrary indicator for market top and bottom. Use the on-chain data as I mentioned, and then hedge, buying a small cheap OTM put to protect the portfolio from a catastrophic loss. So this is important to know uh, for a retail trader trying to compete in this. So the goal is not to defeat the institutions, to avoid being their prey. By understanding their strategies, you can avoid the most obvious traps, which this whole video is about. Make informed decisions. Again, same thing. Gradually align your trading with the flow of smart money rather than against it. This is what I believe in. That's a battle of David versus Goliath. Didn't win by fighting fairly. He won by changing the rules of engagement. Your sling is knowledge, discipline, and risk management. Use it wisely. That's pretty well it. And hopefully, if you like more, you can always, as I said, book with me at bookings button, quantlabsnet.com, where you can press learn, get yourself a free C++ HFT ebook. Thanks for watching.